I'm just writing down a note here. There we go. So Max, first off, I'm always going to read this. It says, thank you, Mike. Great support, great education. Power options is unbeatable. Thank you, Max. I appreciate that. He says, I would like to have some hint or discussion on best strategies for trading QQQ and SPY. Well, it all depends on your market outlook, okay, and what you expect. Let's just take a look at SPY. We're going to be that guy, Captain Hindsight, for lack of a better term, and let's just take a look at the last 3 months of SPY. We had a big decline and then a smooth move upwards that took some time, and then a little hiccup today. I'm sorry, a little pull down, then recovery, and then a big hiccup today. Let me phrase it that way. Okay. Mark adds, need to find a good bull put credit spread. I like that idea. I really do, Mark. And you know, I'm sure you've seen other webinars. That was my go-to right up until January 5th of 2022. I've only traded 9 now bull put credit spreads over 2022 because the market was just too tenuous. Mark brings up a great point, though. It is always better. You don't get as much premium, but you can find a great probability, 85, 90%, delta of 0.15 or 0.10, and still get a good 3, 4, 5% return for a weekly, or maybe 6, 7, 8% for the bull put, bear call credit spreads, or iron condors. Always good to trade those. But you've heard me talk about it at the beginning of the year, Max. Something I was playing with starting mid-January, a little bit, January 10th, I think. And that's when I started to evaluate those 20 to 30, and now I've changed to about 40 to 60 day out strangle positions on SPY and QQQ. Sam is commenting. We're going to go through some more Sam's comments in a minute, but he's also adding he does straddles weekly, and most of the time is profitable. So what's a straddle? We're buying an at-the-money call and put, the 405 call and put for maybe next week's expiration on SPY here. We'll take a look at the profit and loss chart in a minute. But with the wild swings we've seen in the last 3 months, the straddle or strangle position has been working out really well. And over the course of the year, it's been doing really well as well. I think Sam is probably more profitable than me doing the straddles, but that takes a little bit more capital, and I'm just playing around with it. We haven't talked to Sam in a while, but I was playing around initially with 20 to 30 day out strangle positions, going out of the money, to about a 0.3 delta on the call and the put. And, started entry here. So I was able to take the profits on this position and roll it out for another 20 to 30 days. And this one was a slight profit, but just break even. That's when I realized I wanted to target maybe 40 days out or more. So rolled this one out to here in that situation. And I was able to roll some profits on the calls here, take profits on the puts here, move it back out to here. Really good profits. In this case, I didn't take profits here, pretty sure. But then rolling back out, I'm in a September one right now. Not a weekly, just a standard September 16th that we rolled to. No, I did not pick the bottom correctly. I think it was here. Somewhere in here, I rolled it out. But we did take profits on some of the calls here already. And interesting, now the puts are starting to go profitable here as well. Oh, and Sam adds his losses are not that big when he has them because I have 2 expirations to cover the premium. Mostly my losses are small. Yeah, that's the proper position sizing. So I might be doing this wrong, Sam. But I'm doing a small position size of my portfolio, doing the 0.3 delta strangle positions and rolling them when profit is taken at a certain level on one side or the other as well. I do not keep delta neutral. My role is not related to delta max. My role is more related to the profit level I'm taking, that my target profit on the call side or the put side, or the strangle as a whole from the beginning. Usually it's the strangle as a whole I'm looking at, not just at the call or the put. And then when I roll out, I just keep the same 0.3 delta. Okay. In that case. And Sam says his position is 2% of his portfolio for trade. That's where mine is. I started at 1% just to play with it, Sam. And then when the market started doing all the craziness in January and into February, I said, I might put this up to 2 to 2.5%. I think at one point I was up to 4% because the small loss I took, I kind of gambled with 4% of the portfolio and it worked. So it got the whole strategy back to break even. But yes, Yeah, not your account, your portfolio size. Oh, 2% of the total portfolio size. Excellent, excellent, Sam. So, related to Mark's comment, iron condors, bull put credit spreads. It was in February where I started those first 7 bull put credit spreads, and we needed to manage 3 of them that went against us, but 2 of them were managed using the pendulum for a profit. 1 was a break even. So we were successful 6 out of 7. We didn't really lose on 1. So 6 out of 7 times is a good success rate, but that was just in the month of February. And then I was gun shy. I missed this opportunity on bull puts. Here was mostly bear put debit spreads. Following once it dropped below the SMA 20, and we see a negative MACD, I'm looking at bear put debit spreads in those cases. This wasn't big enough for me to try a bull put credit spread. I didn't like it. Here, I think I was still in the strangles. But as this started to turn, we're doing bull put credit spreads on stocks, I should say, not SPY, but this would have been the time to do that. As you can see, the iron condor position would have been tricky because of the volatility of the market, the volatile movement of the market. You know, taking losses here, this might have been a small loss here, but looked pretty good. This might have been a small loss here. You would take a loss on the bear call side here, loss on bull put here, loss on bull put here. I'm trying to go every 2 weeks. Maybe a loss on the bear call here, depending on where you opened it. Big loss on the bull puts here. Then doing pretty well and probably could have managed the bear call, but we're increasing rapidly, so this side's being threatened again. And then today you might have gotten hurt on the bull put side. It's the iron condor in that case. I don't think this has been the year for it, even with a low delta of 0.1 or 90% probability. I'm going to run a test. We're going to do iron condor tests, SPY, weekly and maybe every 2 weeks out, using a delta of 0.15 or 0.10 or less, and just let it run without a stop and see how it performed. I know at one point, my standard bull put credit spread approach, I analyzed this for a customer. If I had done my standard bull puts, even with my stops, at around this point here, the portfolio would have been down 82%. Interestingly enough, a similar bear call approach during this time would have only been up 6% with the 2 week out spreads because of the losses you took in those cases. Okay, Fernando, I don't know the answer to these questions. We're not going to get into it, Fernando. I'm not trying to ignore you, but I just don't have it. You said, how does Sam counter the theta decay and vega decay when implied volatility goes down? If implied volatility goes down, that usually means the market's going up. So the call side, at least in my strangle, is the profit is countering that in that case, Fernando. Okay. Not a lot. There's still going to be a volatility crush. One thing I'm also going back and analyzing for my strangles personally, Sam probably already has this factored into his, I'm sure, but is not going in when the implied volatility of the SPY options are in the 80 percentile or higher or 70% or higher of the percent implied volatility range. And so what have we talked about here? We're talking about SPY and QQQ. We talked about strangles and straddles. We talked about bull puts Mark had mentioned. We talked about the risk of iron condors, but we also talked about bear puts following when the stock is in the trend with the MACD and the SMA 20. Max says, what about calendar spreads? Ernie and myself in January, we started talking about, I think you were part of the discussion, Max, earlier on in January. We were talking about the bear put debit spreads, which sometimes were the calendar put spreads because the market as a whole was showing bearish. However, at what point do you decide you want to convert to do a calendar call spread, which is usually a 2 to 3 month out call? Well, here you get a fake out. It looked like we're in a subtle bullish movement, a fake or bear market rally here. We're above the SMA 20, the MACD is increasing, but only the last 10 days, and we're back down to here. The calendar calls would have been destroyed. Percentage-wise, right? Stock falls 8, 9, 10%. The long call that's 2 to 3 months out, you're going to be down 25, 30, or 40% on that position. Proper position sizing is key for any kind of vertical spread, including a calendar, which is a calendar spread because of the lie of leverage. But then here, yes, I want it to be in calendar calls, but then this probably took a big chunk out of your calendar call positions. It's still about timing, just like I mentioned with the bear put debits, with the bull put credits. And I don't think the double diagonal, where I do a calendar call and a calendar put, which looks similar to an iron condor, can be managed effectively because we can adjust short calls max and short puts against calls that might be 2, 3, 6, 8 months at a time, and puts as well that 2, 3, 6 months out in a double diagonal strategy. But with such wild swings, you're profiting on one but losing more on the other because of the loss down here or the loss up here in the case that the stocks are moving up in price. Calendars are an effective strategy, but they do result in the right timing. The right timing, Max, is needed. Am I saying that bear puts are better than the calendars or bull puts are better? I think they are with this type of market condition, Max, simply because we can find the trends. And when the trend quickly, if I'm only going out 1 week or 2 weeks at a time with the vertical spreads, same expiration, I can quickly shift from a bear put structure to maybe doing bull puts and then back to bear puts again. If I'm in a calendar put here and my put's out to August and this starts to shift, I've got to readjust this whole strategy now to get out of that position with the calendar puts. Now, I'm talking about a standard calendar put. We're on SPY right now trading at 405.31 right here. I'd likely be buying maybe a January, maybe a December, but probably a January 415, maybe 420 put in the money. And I'm selling an at the money 395 or 400 against it to create this position. It's a high debit trade. It's cost. It's a debit to get into it. But my higher strike in the money put covers the obligation here, so I don't have to put up any kind of margin requirement or anything. It's like a bear put debit spread. I just calendared the position. Great for a bear market if we think the bear market's going to continue. Oh, sorry, 395 or whatever. Now, I can take a calendar put spread and make it bullish. I can sell a 400 put for September or next week or 2 weeks out in time, Max, sell the 400 put and buy a January or December 380, 390, or 370, and that'll give me a profit and loss chart very similar to a standard calendar call spread that looks bullish. The stock stays above the price, my put expires worthless, I keep the entire premium, I can keep selling against it. Because I'm buying an out of the money put, even though it's farther out in time, this would have a lower cost than my preferred calendar put spread, buying the in the money put. It's going to have a lower debit in this case, might even be able to be done at a credit in those situations. But it's the same, it's a parity trade to a calendar call if I use the same strikes. If I bought a January 380 call and sold the 400 or 405 call against it, I'd have the same risk reward profile. It'd be a parity trade in that case. Very powerful for a bearish trend market. It was a very powerful strategy during the first several months of 2022 and even after the little hiccups of the bear market rallies. Calendar puts are great. Calendar calls would have worked here. Hey, they probably would have worked a little bit here too, but then what point do you change? I just like the shorter term bear put debits, bear call credits, or maybe bull put credits to keep it shorter term, knowing that every 2 to 3 months, we seem to have an extended lull one direction or the other, and then it quickly shifts, and before we know it, we're back into the bear market area. As always, though, so what have we talked about here again? One more time. We talked about the structures of vertical spreads. Mark had mentioned that. And again, so we talked about, I'll just write it, credit and debit spreads. So we talked about the credit and debit spreads, the verticals. Been very useful. Calendars have been useful in these markets, but it had needed the right timing. So we've seen some calendar positions that have been good in these situations as well. So calendar put. I don't trade horizontals. Some of you might like to trade the horizontal positions. I don't. I use the standard diagonal calendar, usually, as I mentioned, buying in the money and selling at or just out of the money. And then we had our straddle and strangle discussion, which is something I've been playing with. It's worked fairly well for me. I'm not going to say great, but it's worked very well for me. It exceeded my expectations using the strangle positions, starting at around January 8th or January 10th, testing it out, and then trying to fine tune it in those cases. And maybe I'm doing something vastly wrong, Fernando, but I'm not paying attention to the worry of the theta decay or the vega decay in my strangles at all. I'm just looking at the positions going forward. In those cases, Max. Now, again, one thing I'll say that I'm going to test it for you, Max. I'm going to test it for you too. One of the things that I can always say is always a good idea in any market condition is doing the married put position. I started out here buying at 470, and I had a married put that only had, with SPY, I could be out to January. I could be out 1 year. I'm probably looking at only a 5% maximum risk, maybe even 4% max on those cases with a married put position. So what? It's down at 405 now. I bought the stock at 470. I probably paid $20 for, let's say, a 480 put, maybe had a 5% risk on the position. The stock's at 405. Right now, I'm probably on a less of 5%. I could have adjusted the puts here, adjusted them back up here and done income method number 1 or 6. If I picked it right, I could have done a 12 here and then eventually done another 9 here. Maybe I wouldn't have caught that 12. That was too rapid when that started to happen because I didn't catch the 12 anywhere. But then as this started to move back up, my put was probably at a level of 430 or 420. As this started to move back up, I could have rolled it back up. Even with the market where it is now, down from 470 if I purchased at the beginning of the year to 405 with the fluctuations, the married put structure, and the 13 income methods, I'm not going to guarantee that I could have been bulletproof. I'm not going to claim that. I think I would have caught a 12 here midway through, but I would not have caught this 12. But with 9s, 4s, income method number 1, I think this would be bulletproof or only at a loss of 1 or 2%, and I'd likely be holding maybe the 440 or the 430 put in this scenario. Still with 4 months to go, with a low risk position and the potential to still profit to the downside, make income methods to lower the cost basis. I'm going to try to run that for you, see what I can come up with to elaborate on this discussion a little bit more with the potential discussion of how disastrous potentially SPY iron condors would have been as well. Sam adds, this market you need to be very careful. I'm always selling the rally, not buying upside bets and trying to buy contra ETF like SQQ. You've heard me say VIX, doing the VIX, UVXY, they just haven't been performing. So he's hedging by contra ETFs. SQQQ, SRTY, SOXS is a good one, and SPXS. TQQQ is also a popular one that's been discussed here in those cases. And Sam mentioned, his straddles, he likes to use the weeklies, and that's there as well. Sam added earlier, he got 10% for the Contra ETF last Friday, sold out entire portfolio, and went into the Contra ETF there as well. And he's holding one stock right now, which is Apple, which is a radioactive trade. It's more of a wheel position, but in a radioactive trade as opposed to a standard collar. And related to that discussion, Fernando, Sam says, I don't worry about theta decay because I buy 4-month options, calls or puts. I'm 60 to maybe 70 days out. And he's selling short-term against it. That's sort of his theta. That's one thing I'm not doing in my Strangles, Fernando, that Sam is doing, and he's discussed with us before in his Straddles or Strangles, where he's 4 months out on the bought calls and bought puts for the straddle or strangle, and then he's selling shorter-term puts when the market's going up, shorter-term calls when the market's going down to continue to hedge. And that works as a theta decay, a theta hedge, fighting the theta decay, I should say. In those cases. So that's what I have for that. And so, Max, I hope that was a useful discussion for you. I know we would like to elaborate a little bit more, but I don't want to go into the back testing. I want to run the back test that I like to use in the background, not doing a manual one for the Iron Condor test, but I'm going to have to do a manual one to guess how I would have played SPY as a married put had I opened it on January 5th. I think it's June a moment ago. If I opened it on January 5th and where it might stand today. And no, even though I'm Captain Hindsight doing this, I'm not going to pick the tops to sell a call, and I'm not going to pick the bottoms, or when I see a trend and I see 2 months later it's down 15%, that I'm going to use income method number 12. I'm not going to cheat like that. I'm going to base it on what I would look for on the percentage movement of my underlying security and what income method I would consider based on market conditions at the time.